So just a little, so just a little
Sorry
bit
about that,
about,
John.
no worries, bro. Just a little bit about me. So my professional background is actually in investment management. So Dennis, I'm sure you remember, I worked at a hedge fund in New York City. Love New York City. I think a lot of your audience is from there. I consider it my second home. And I also work for a large fund manager in Los Angeles, where I'm from. And so I have bit the investing bug pretty hard when I was in college. I love all aspects of investing. I think it requires that you learn as much as you can, and then you place your bets, and hopefully you're right, and you get rewarded if you are, right? So I love that part about investing. And so over time, I would say since 2003, my wife and I actually started investing in real estate. And like many other people, we started with single family and did some small multifamily in Los Angeles. So we've been at it for over 20 years. And over time, some of you guys might know, California is not exactly a business-friendly, landlord-friendly state. And so having to deal with various issues over the years and not wanting to take on a second job and making it bigger for us, we eventually learned about syndications. And so for the past 6 or 7 years, we've been increasing our exposure, our real estate exposure, primarily through syndications. As Denis mentioned, passively investing in over 50 deals. And I will continue to invest in passive deals for the rest of our lives, just because I like leveraging experts in various geographic regions and different asset types, and obviously spreading my money amongst different operators. And that's my journey as an investor, both active and passive. And as Denis mentioned, a few months ago, I had the opportunity to join Gary Lipsky with Break of Day Capital. He has become a really good friend of mine over the years, and he went active dove right into multifamily syndications, and I have been investing successfully with him. In fact, I've done 6 deals with him so far, and really like the way he did things. And so when the opportunity came to become a member of his team, this had become my dream job, and this is where we are today. And this is how Denis and I connected, and so hopefully that's enough to get us going here.
Yeah, Joseph. So one of the things that I loved about your story when we first talked was this road trip, right? I think this is one of the coolest things. I feel like this is like a rom-com movie script. But tell us about this road trip you took, and what would you recommend if someone else wanted to take something similar? And give us a little background on why you took this road trip, what you were going for, give us the whole 9 yards on it.
Sure. Yeah. And we have been hands-on real estate investors all that time, as I mentioned, from 2003. And in 2016, when we started going to various local RIAs, networking events, even regionally, as we got to know about syndicates, okay, now we have to transition from being active and turning our money over to somebody else to manage. And how does that all work? And who is it that we're entrusting our money with? It's very interesting because people just put their money in the stock market and really probably couldn't even name half the management team, but we just blindly give them our money. But we're doing the same thing with these private equity syndications. And so when I was starting out, I didn't know who to trust. Just like many of us, we listened to podcasts, we maybe read someone's book, or maybe someone mentioned something, but you had to put a lot of trust into these people. And fortunately, we had the opportunity to take time away. We wanted to leave our W-2 jobs, and we had the opportunity to we decided to take a 2-month sabbatical. Both my wife and I left our W-2 jobs. She was in the restaurant business, I was in finance, and over time, we also found ourselves in various business ventures, including a restaurant business. And so we finally decided to step away and to become more passive. And we decided to take a 2-month road trip, and to make it expensible, right? As a real estate investor, we wanted to incorporate meeting with sponsors, checking out properties. And this was actually basically across the United States, right? So we basically did a circle around the entire country, and took us 2 months. And I probably tell you a little side story. My wife used to lease a Mini Cooper, and the lease was coming up, and she had 14,000 miles left on her allowance. And hey, let's beat the heck out of this car, right? So we took a Mini Cooper across the country, all our stuff in there, and we were buying gifts for our nieces and nephews, just stuffed it with all kinds of stuff. But Anyway, we were going around the country. We made it up through the Pacific Northwest, met up with Brian Burke and with Praxis Capital. They were some of the first sponsors that we invested with. He has a big following on Bigger Pot. Went up and met with him. And the funny story there was like, he told us how few people actually came to visit them. And it was actually rare. It was so rare for us to go up there. So that kind of resonated with what you were saying, Dennis, about not many people being able to do this or wanting to do this. But I really encourage you to do it if you can. And then we went west a little bit and went east a little bit and went to check out this development deal in Reno that we were investing in. And then again, making our way across to the East Coast. And we met with a DST sponsor on Fifth Avenue. And then we made our way down to Florida because Praxis had a couple of deals actually in Georgia and Florida. These were two of the first syndications that we invested in. One was in Georgia and one was in Florida. So we actually went and visited the properties, and they set up the meeting for the property manager to show us around. And then again, and making our way back through the Southeast. And then we were investing in a couple of deals with Ashcroft, and those guys were buying primarily in Texas. So we got to see a couple of deals there. And then eventually made our way back to California. So we did this 2-month trip where we got to see properties, meet sponsors. We got to eat lots of cool stuff. We met up with friends and family members and got to incorporate. We went to Niagara Falls. We went to Disney World. We went to the Cape Canaveral, and then also to Houston, the other rocket launching area, whatever you call it. And then actually during that time, we even had to avoid a couple of hurricanes. I think we had to reschedule our trip or change the scheduling to avoid, I think it was Hurricane Irma was rolling through Florida at the time. So we actually had to turn around and then got to experience a hurricane evacuation, which is something people from the West Coast like me never had to experience. So that was funny and cool. And it was funny because then Burke was like, they were slightly worried about raising capital for that deal in Tampa because of the hurricane. It blasted through there. So that was interesting. And hopefully that gives you guys a little flavor of what we experienced in those 2 months. But just to finish up on that point, I would definitely encourage passive investors to, as much as you can, try to meet with the sponsor. You can only learn so much about them reading their deck or even on a Zoom call or even a telephone call. It's a really different feeling when you're face to face. You get that belly to belly, you get that gut check, right? And that's really important because when you get comfortable with them, if they feel right to you, everything checks out in person as they do on paper, you're more likely to want to invest with them, in the future.
Yeah, I love that, especially you're telling us the Praxis story and how you met Brian Burke and his team, you also met a couple of property managers. What I find is usually you could be fooled by one person, but it's hard to be fooled by the culture of the organization, because the red flags will come out at some point. So that's such a great tip to not only meet one person, but meet multiple members of that organization. Because especially if you're going to be investing 50, 100, 250,000, it's an extra conversation. And if the operator is holding back, then there's a flag there. So I think that's such a great tip you just gave, is don't only just meet the head, because usually the head guy, that's the marketer guy, that's the guy that's out there, that's the guy who's almost a professional at talking to others. But when you start talking to the other levels of the organization, those are usually not the professional marketers. So usually that's where gut checks will come really quick at that point. Whether or not are they dedicated, are they loyal to are they talking bad about the operator, everything like that. So I think that's a great tip. The other thing I want to get at is when you are scheduling these meetings with these operators, were you telling them a dollar amount that you were looking to invest with them? Have you invested with them previously? What made them want to take their time to take that meeting with you?
No, so they do at the level of interest, but no, I didn't. I really didn't have to tell them how much I was going to invest. I simply presented the fact that I am an active real estate investor, but I don't know much about the syndication world. I was very upfront with them what I knew and didn't know. And I just told them that I need to get comfortable. So I need to see these things. And the good operators, and to your point, Dennis, they're going to they're going to be transparent and they're going to show you what they got. And that's potential red flag there is if they don't want to take the time to talk to you, to help educate, help you with the investment process, then maybe they really don't want my business. The good operators, and this is certainly the way we want it, the way that we conduct our business at Breakup Day Capital, is that we don't want to just do one deal with you. We want to have this relationship with you, and so that we can do this long term and do right by you, so that you'll keep wanting to come back to invest with us, because you like and trust us, and that we're doing the right thing, especially when no one's looking, right? So I feel like those operators that took the time to help educate me and make it accessible for me to see what's going on behind the scenes. And especially in Denis, it's not just the people, right? It's also, you tell me, okay, you're doing this value add, you're adding amenities, you're doing this and that. What does that even look like? Okay, sure, I've seen you posted a few pictures, maybe a video, but I actually saw exactly, okay, this is a renovated unit. This is a classic unit. This is what they're installing. You get to see that, like, you could touch it. So again, nothing really beats being just able to see all these things like in your face, like within reaching distance.
No, it's such a great point. I always, when we syndicate, we try to syndicate actually locally, and most of our investors are locally because of that touch and feel. We could do an event on site. You can go and visit the property you own. Like you mentioned, I guess a couple of your areas, the Southeast, and a lot of high net worth individuals in the New York, New Jersey area, they're investing in Texas and Florida. But it's like almost, hey, you're doing your 8th deal, your 9th deal. You're never going to get that touch and feel unless you're actually going out there. So it is really important. I love that point on the touch and feel. I wanted to ask you, when did you actually take this road trip? I should probably know when Hurricane Irma hit. Just when did you actually, and I'm curious, I guess 2 questions. When did you take the trip, and what was the capital raising environment at that time? Because what I find is true is that, especially when I was really heavy in the LP stage, it was almost like when the money was really easy to get, you see the attention from the operators, not all, right? But some operators won't really take the time to respond to your email thoroughly, because I guess the easy money is out there, versus they're going to have to work really hard when things are tight, I guess, as it is now. So what kind of capital raising environment was it? And do you think it would have been different if it was a harder environment, or you just think the operators you chose are just really good operators and didn't matter what environment it was?
So this was from July to September of 2017. And if I recall correctly, we were obviously the issues from the great financial crisis. As you attend these different meetups, and people will continue to bring that up, even though at this point we're already well on our way to growing again, and you're seeing price appreciation. Dennis, to be really frank, couldn't really tell you, and maybe because I was just such a newbie then, I couldn't really tell you if capital raising was very hard or very easy at the time. I would just say it was probably okay to raise. I think it was probably more easier than harder. It probably was not as easy as it was like doing 2021, when literally, because the Fed printed so much money and kept interest rates at such a low rate, that artificially low, that people would just throw money at anything. And operators, or even just people raising capital, it was so much easier to raise. Maybe it's because I took the time to talk to these operators, sponsors, and the fact that they were responsive probably meant that for the most part, these were the better ones.
Got it. And then the last question on this road trip before we move on. What kind of questions were you asking at the end of the road trip that you wish you would have asked in the start of the road trip? What did you get better at towards the end? And you're like, you know what, if I had to redo it again, the first couple of operators, I really wish I would have asked them this or that, or maybe you sent a follow-up email actually asking that.
Dennis, the truth is the road trip was only 2 months. And so for me, it was just more like getting that gut check and then physically inspecting what I'm investing in, and then understanding and seeing with my own eyes, like what that value add process, that value add business plan looks like. I would say that I really didn't have a good grasp of what a good operator is, or maybe the things that I should have known or that I would have liked to know until more, maybe the last couple of years when I actually have empirical data, what didn't work. Okay, so maybe we can talk about that later, but it took some time to see, oh, okay, these guys all sounded great. Some of them had already had a lot of experience and some of them did not. And then now we can look back and see in actuality what really happened.
So I think that's a good transition. So let's say 5 years later, 6 years later at this point, right? What is the experience Joseph would have told the inexperienced Joseph? What questions to ask? What you learned from like now looking back at it, what would you have done differently?
Okay, so let me put it this way. I'll start by giving you a summary of what an operator that I would like looks like. Okay, so I'll describe that. And then maybe we could talk about some of the red flags, or just as soon as I see something like that, I'm out. Okay. All right. So this is over the years. And again, this is not a right or wrong answer. It's just my own personal pet peeve, or not pet peeve, but my own personal bias. Okay. So just take this with a grain of salt. My favorite sponsors look like this. They are niche experts. Okay. They specialize in what they do. They're focused in just a few markets, and they're not looking around to getting into the next hot thing, the next trendy thing that the people are chasing after. So for example, I really like value add multifamily. It's something that I understand really well. It has legs, it has long-term, it's like a mega trend because of shortage of housing. So I really believe in that thesis. Okay, now it may or may not temporarily fall out of favor. And so what we do see in our industry is people who are not able to take down deals or not patient enough. They're moving on to like raising money for car washes, to ATM machines, to RV parks. Now, again, I'm not saying there's anything wrong with those asset types, okay? But they're not experts. They're just because they're chasing after the next thing, right? Oh, if there's more cash flow with car wash. And so they're building on the industry, right? Or they're building on the asset type that they started in. And I like operators that will focus on what they do, what they know, what they do best, whether it's a bull market or a bear market, right? Because really, it's when things don't go right, when things are tough, whether it's economically, business cycle-wise, market cycle-wise, or something happening at the property, it's like when you get punched, it's like, how do you deal with adversity, right? So you're not going to know who's really good until they get punched in the face, right? And so the guys that focus on what they do, those are the guys that are going to have, there's going to be a much better probability of a successful outcome. And so I look for that. And what else? Track record. It is huge. You will probably hear this like it's a cliche, but honestly, it comes down to track record. It's just, if you need a medical procedure or if you need an operation, you're not going to let some kid that just graduated medical school and barely starting on residency to opt to experiment on you. I'm sorry. The young syndicators, the young operators out there, younger guys with less experience, I'm sorry, you're going to have to pay your dues, okay? You're going to have to learn this. You're going to have to build up a track record, because everybody, you have to go through that process. You have to earn that to manage people's money. When you are a fiduciary, it comes with a lot of responsibilities, and nothing says more about what you're capable of when you have a good, strong track record. Doesn't mean that you don't make mistakes. You also want to be able to articulate what you've learned and how the lessons that you learned and how you're going to do things differently the next time. Track record, niche expert, having a team who does this full time, who's focused, preferably a team that has professionals in key aspects of the business. Like, for example, in value add multifamily, you want somebody who is focused on asset management, maybe acquisitions. You want somebody like me, whose responsibility is to continue to stay in touch, educate not only existing investors, but future investors on what it is that we do, and keeping you updated on what's happening with the business, right? Transparency is big in this industry. You have to keep your investors abreast of everything that's going on. You're safeguarding their asset. You are a steward of capital. You got to make sure that you're handling their money properly, and that they can continue to trust you, right? And maybe just have like an operations manager too that can handle all the paperwork, helping you gain access to your paperwork and stuff like that, right? So this is ideally what I like to see. So let me take a pause there, and then before we get into some of the red flags, if there's anything that you want to dig into deeper there, Dennis.
Yeah, like in my head, I had like question or follow-up comment, but I didn't want to stop you because you were on such a roll. First thing I want to say really quick, Joseph, is that Joseph's checklist is not financial advice. I just wanted to give that disclaimer. This is just something he's learned as a passive investor that might be helpful if you were to use it. You should always consult with your financial professional, legal professional, all of that usual stuff. So I just wanted to throw out that disclaimer. So I wanted to make a couple of points. And I think one of them is the difference between track record and the difference between when you see a newer operator, they'll jump on a GP team, they'll be like 0.00000% GP, and now they're turning around and underneath their LinkedIn profile it says $85 million assets under management. But wait, like these people 2 months ago had zero, and now where they go 0 to 3 years with $600 million on the asset management. To me, I get so turned off when I see that, where I almost hate using assets under management because I would rather be 40% owner in my $10 million assets under management than 0.0001 and then speak like they almost trying to force the track record versus actually paying your dues, how you said. So I wanted to throw that out there. The other thing I wanted to throw out there is I was curious, I guess two things I wanted to point out. One, I was curious on your take on, I know you said you see operators go on to the new trend. What do you think of when you see capital raisers where they're not really involved in the operations? Like how big, I guess this is more of a red, let's skip it because this is more of a red flag suggestion. Let's skip that. We'll get back to that question. The other question and follow-up comment I had, when you said operational team in key roles, we at SIH Capital, we have a pretty small operational team. And something I talk about with my other general partners is we never want to grow to the point where we don't enjoy working with certain members, but we need them because we need a team. So we are very choosy. We have 4 people and I love working with every single one of those people, but I know if I had 20 people, that wouldn't be the same thing. So as an LP, how large of a team? So I understand the importance of having key roles and then having backups for these key roles. But do you also get discouraged when the team is 30, 40 people and this is a down year for transactions? So now what are you doing? Because I look at it where a couple of years ago, some of these operators had 3 people on their team and now they have 30 or 40. And now I know they have to do deals and it makes you question the validity of those new deals. Are they doing it to support the 30, 40 people? What do you think, as this is strictly as you as an LP investor talking, not as head of investor relations for Break of Day talking?
Yeah, no, Dennis, that's such an important point. As a limited partner, it makes me suspicious or a little bit skeptical when I see a large operation because, and I'll be frank with you, some of our competitors in the same markets that we operate in. Oh, by the way, I want to mention that there's a difference between an operator and just a syndicator. An operator is somebody who's actually boots on the ground, and we're responsible for everything from acquisition to sourcing to finding the deal and getting that deal, to managing the deal, and taking it into full disposition and returning investors and profits to our investors, as opposed to somebody who is just potentially just raising capital and that's it. Okay, we can talk about that later in the webinar, Dennis. But I just want to make that clarification. But when I see a large team, okay, we know one that's 200 plus people, right? Well, big operation. These guys must know what they're doing. They've been around for 2 years, right? They grew super fast. You have a lot of overhead when you have that many people, so you are naturally motivated to want to do deals. And sure enough, these guys are doing a deal a month. And right now we're in this funky period. We're in this flux where prices should be coming down because of higher interest rates and higher operating costs. But the sellers who don't have to sell yet they're still stuck to the prices that we were seeing 6 months, a year ago, which was it was peak pricing. And so if you're a shop that's doing a deal a month, it makes you wonder, are you really getting the best deal for your investors? And I just hope nobody figures me out when I give you a little bit more clue. But this particular team that I'm talking about, we actually went after the same deal. We only came up to 22 million for this particular asset, and they bought it at 26.5. Okay. And I'm like, why was there such a discrepancy the way we saw the same asset? And so makes you wonder, okay? I'll just leave it there so I don't want people to figure out who I'm talking about because they might be able to. Am I missing? Yeah. And so just to finish my point and resonating with what you said, Dennis, is that you want to have big enough team where all the key roles are covered so that you get really good at what you do. But you don't want to be so big where you're doing deals where just to keep the lights on. You're trying to get acquisition fees just to pay the employees. Like, we don't want to be in that position. And that's actually strategic from Gary's part, our CEO, is that he wanted to keep a light footprint so that we can go for many months. We've gone as long as 13, 14 months without a deal, and we're fine.
So many great points. Let's move on to the red flags, because I feel like this is probably going to be the best part of the conversation, even though I love the journey and I love going over everything that we're going over. We might have to definitely do a part 2 on this. But let's go over red flags. As an LP, I know you see deals more from the GP side of it, but you get the offerings. I also get investors that send me other people's deals to take a quick look at it. They know I've done quite a bit of deals. What do you see as red flags? I definitely want to keep this open-ended because I definitely got some recent ones. You might have heard a big alternative asset, let's say, has just been identified with an SEC investigation. So I think we could pull some red flags from there, but let's go over some of the big ones. What are the red flags that you look for that you just scratch your head and you're like, really?
Yeah. Yeah. And in fact, Dennis, the interesting, before we get into some of the nitty gritty, because, sometimes they're really good at hiding stuff, but let me just start with one really obvious that any passive investor can use. Okay. And it's the example I want to give is this. So too good to be true. Okay. That's the theme. Okay. I recently saw a deal come across. It was a Class A luxury property and with little to no value add. Okay. So just in case some of the audience that might not understand, there's no upside in basically you cannot fix up something to, let's say, bring rents from $900 to $1,300. Just there's not a big rent increase. It's simply the property's already stabilized. It's at market rents. So think of it like it's already at $2,000 a unit and it can only go up like $100 next year, just whatever the market gives you. And so this Class A deal, they had a projected IRR return of 23%. All right. Dennis, I don't know if you're chuckling right now, but a Class A deal that's stabilized, investors will be more than happy to invest in that deal at 12%. Okay. Because these things don't have a lot of upside. You get a lot of cash flow as the investment strategy, and that's perfectly good. But to have to advertise it at 23% IRR, it makes absolutely no sense. And the sad thing about this deal is that these guys, maybe because I stopped digging after I saw that IRR, I'm just like, yeah, this is yes. But these guys, I think they were claiming that they have over $1 billion AUM. Okay. So I'm like, okay, so if you are true, you obviously have a lot of experience. Why do you need to advertise your deal as such an unrealistic projected IRR? Even if you could hit it, why would you ever advertise that? You're setting yourself up for failure. Why not just tell people a realistic number like 12%? And then, hey, if you do hit 22, awesome. You look even better than you sold your deal as, right? So that is such an obvious, huge red flag. So I want to start there.
Yeah. So this is such a great point. So out of like my 12 to 15 deals as an LP, Most of my early deals I invested in were all 20+% IRRs. Not one of them hit 20% IRR. So I always laugh at the 20%. And then what I've learned from being an operator and stuff, I find the mid-teens is the sweet spot. But then as an operator, you should have ways to get it to the 20% IRR, but you should only be showing the 13 to 15. But you want to have, I call them levers. I'm not underwriting a water efficiency plan. That's easy, low hanging fruit. We're going to do that. That should get us a percent or two. I'm not underwriting a refi. That should get us a percent or two. I'm not underwriting rent increases because right now it's a little dangerous to be underwriting rent increases. But if I do get us a marginal rent increase, good, that's a bumper too. I'm underwriting 55% operating expenses, but realistically speaking, I think I could do 50. Like I call them these levers, and between you and the general partnership team, you need to be very familiar with them, but you should almost kind of leave out some of these levers in the underwriting. So show them the 13, the 14, the 15% IRR and hold back the 20s for that upside, because I've never had a 20 actually perform in my history. I don't know about you.
Yeah, no, that's right. And actually, I missed a subtle point. The Class A deal that I was just telling you about, projecting 22, 23% IRR, what we specialize in is in that value add space where we're making improvements and getting the rent bumps, right? So even those kind of deals, which is quote unquote riskier, slightly riskier, we're only underwriting to a 15% IRR. And to your point, Dennis, we are trying to get above 20% internally, right? But we would never advertise that to our investors. Just to help the audience understand this, you have a riskier deal, okay, value add, but we're only projecting 15 IRR. And this luxury deal that has no upside is at 22%. I want to just add that little color there. Okay, I forgot it earlier. And is it okay if I jump into some examples of red flags that I look for?
Just 1 second. I just wanted to add to that not all IRR is also equal. IRR, the biggest weight to R is basically time. So if you could get a quicker return of capital, so if you're looking at a deal and the only way that they're getting a 20% IRR is because they're saying they're going to be out in 2 years and 3 years, and you're in today's market where deals don't really trade, you have to question what happens if this 2-year hold becomes a 5-year hold or a 7-year hold and a 10-year hold. And that's the question you need to ask in an email. You actually have to say it like that. We noticed that your hold period was 2. What happens if you're at 5, 7, 10, or you can't do a refi at 2 or 3? Because that is the only way you get those 20, 30% IRRs, where remove that. How does this deal look at a 10-year hold? And on top of that, what is your operational experience? Because you might have all these deals that exited. There's a couple of big operators out there. I'm not going to throw out any names, but they advertise heavily their mid-20s track record, right, of IRRs. But what is their experience on holding a deal 5, 7, 10 years? Because the mid-20% IRR implies all short holds for the most part. Like it's rare to get a 10-year hold that's a 25% IRR. So you're looking at that deal and you're looking at that track record, you almost have to question the too good nature of it and say, we might not be exiting this deal in 2, 3, 4, 5 years. And what is your operational background on a 10-year hold? And what does that look like on the IRR? And you'll be surprised at what you'll find. And also the quality of that response will dictate a lot on your relationship with that operator going forward.
Yeah. We definitely, the last 2-3 years, maybe not the last 6 to 9 months, but the last 2-3 years, we definitely got a huge lift from the market being so generous. So certainly you don't always have those market conditions. And then Dennis, if I could, I want to add something to what you mentioned earlier. When you talk about refinancing, right? That's a trick that operators can put on, or they can use to make their IRRs look better, because to your point, it's you get your capital back sooner and that inflates your IRR. So that I kind of want to mention about, I've seen deals where the operator actually put in 2 refis, okay? One in year 1, one in year 3. To your point, you should not be underwriting to a refi because that's an uncertain event. To put in 2? Come on. And so just these little red flags alone, when you start to know what to look for, it's enough for you to just walk away, because That tells you everything you need to know about the character of the operator. Because if they're going to do this, what else are they going to do that you cannot see?
Yeah. And Joseph, last point on this before going into, we probably only have time for one more red flag. But
Cool.
The other point is, too many times an investor looks at the offering memorandum and they see the key facts page and they see the 20% IRR. And too many times their due diligence stops at that point versus requesting. Most of the time, the P&L is not going to be in the offering memorandum, but you must, like, I have to say this, you must request a P&L and compare it to the T12. That is the only way you're going to know if this deal is conservative or not. Because personally speaking, I think conservative underwriting should be banned from the lexicon of all operators, because conservative underwriting and due diligence, those are two terms that need to be removed, that should be illegal to use because it's just used every time. So the point is that I wanted to say is the only way you're going to know about the IRR, the only way you're going to know about these refinances and everything like that is by looking at the P&L, look at that pro forma and say, hey, where is that coming from? And once you start seeing it, the red flags will start. And usually the thing is, once you see that one first red flag, all the red flags follow after that.
Yeah, exactly. I know we're running long here, so let me just give you, I want to try to add as much value as I can. So let me just give the audience a few tips to look out for when you're evaluating deals. Starting with what Denis just said, when you look at the T12, which is the trailing 12, right? This is what the property was what it was performing at the last year. And you look at the year one pro forma, which is what the operator is projecting. And you look at the rent and look at the net operating income. If there's a huge difference, that's a red flag, right? If the property was making $1 million last year and they're projecting like making $1.3 million in year one, unless this is first of all, see, even a stabilized asset, you wouldn't see that. You wouldn't see such a huge jump, particularly in a value add and strategy. There's so much turnover, and even if there wasn't, you don't want to underwrite little turnover, right? So when you have a lot of turnover, you cannot count on the rent being collected, and so therefore you should not see a big jump in the NOI. Okay, so that would be red flag number one for me. Number two is looking at what they're projecting for rent growth, right? And especially right now with the recession looming, you don't want to see 10, 20, 15%, unless they can really, certainly it warrants a question mark. You ask the operator, how do they come up with this 15% when we have a looming recession, right? So number two. Number three, look at the expenses. Make sure that the expense ratios are properly projected throughout the years. When you see enough of these deals, you'll get a feel for what they should be. And obviously every market's going to be a little different, but it's somewhere between 35 to 50% of the revenue. Okay. And again, if something looks off, just ask the operator and see how they answer. And that's how they answer the question is also pay attention to the that's another clue that you're going to have. Another one would be, this is a really big one, reversion cap rate. Okay, so this is the cap rate in which the operator thinks that they can exit the property at. The cap rate is essentially the inverse of a PE multiple. So when you play around with stocks, oh yeah, if this is a high growth company, you're willing to pay a richer premium or richer valuation. You're willing to pay a higher PE, right, for the stock because it's supposed to grow like crazy. In properties, there's the inverse, and it's called cap rate. And so the lower the cap rate, the more valuable that stream of cash flow from the property is. And so one trick that an operator can do is to make that reversion cap rate, which is the valuation that they think that the property can exit at. If they artificially reduce that number, they're basically saying that they can get out at a much higher multiple, right? And so just a small change is enough to make the deal look really good on paper. So the question to ask the operator is, what are you using for reversion cap rate? How does that compare to historical averages? And ask and see how the answer comes. Sometimes it's really obvious. This number is clearly too low, right? But if the number is on the higher side and it's still projecting a nice R and equity multiple and yada, yada, so on and so forth, then that's an example of a conservative underwrite. So I'll stop there, Denis, if you want to chime in.
I'll definitely say I think the cap rate reversion is probably the biggest red flag there is because it also has the most impact. When you change that, if you go from 5.5 to 5.4, magically you went from a 16 to an 18% return. So it's probably the variable. And that's where a lot of people, they feel like underwriting is too complicated and they trust the operator. They don't need to take that one step, taking like some basic underwriting courses. And there's a really good syndicate. I always recommend some of my investors to sign up for the syndicated deal analysis. They usually it's $150. He's got Michael Blanc has like a really great workshop on it. But being able to plug in the operator's assumptions and seeing and then playing around, there's really five major variables that have such a major impact on IRR and returns. So Joseph, that's a great point, is the cap rates. Ask them, what are you projecting? And in that case, in the previous deal with that Class A operator, like I guarantee that cap rate, he was actually underwriting a cap rate, a compression, and not an increase, which you're technically supposed to do. It really depends on the asset class and the market. Maybe you could do it, keep it as a stable, but in reality, you're supposed to be gradually increasing the cap rate, assuming things are going to get slightly worse every year for your whole period. But when you don't see that, those are some clear red flags. And great points, Joseph. I definitely want to have a follow-up call because I could think of maybe 10 more red flags
Oh yeah.
that I think would help. And I like that we hit the major ones. Let me see some of the questions. I think we covered this, but I'll restate this question. This is from Preston. What specifically is the danger with a syndicators team that's too big, that their large overhead will be unsustainable in a downturn? And if you want to chime in, and then I guess I'll chime in on this specifically.
Yeah, it's just that when you have a very big team, you have a lot of mouths to feed. And that means that you are incentivized to do deals because operators, they get paid when they also acquire a deal, right? There's an acquisition fee, there's a loan guarantee fee. There might be other fees that they can throw on top, right? And those fees could be pretty big number. A couple percent of a $50 million deal is $1 million of acquisition fee. That feeds a lot of people, right? And so when you have a big team, you are going to be under pressure to take down more deals, right? And sometimes a deal's just not there. Real estate is very slow moving. And so it takes time for things. The stock market moves like a speedboat, right? Real estate moves like a cruise liner. And so it takes time for things to play out. And when you have a lot of mouths to feed and you have to keep doing deals, sometimes you are going to inevitably maybe buy a deal too aggressively. And I'll just illustrate this whole, what Denis said earlier about the reversion cap rate. So remember earlier, I was talking about how we arrived at $22 million to pay for this one asset. And then the other guy was able to go to 26 and a half. It was because of the reversion cap rate. We were in the, let's say 5.25, okay, reversion cap rate. They were down at 3.9, all right? So that's just so you know. And then this was the shop that has a big team, okay? And they have to take down deals. Hopefully that answers part of the question.
Yeah, I'll throw in two things to that. First off, when you have smaller teams, there's going to be more equity percentage of employees that are equity owners of these deals. So there's a more aligned interest. Just think of it this way. If you have a team of 7, 8, and 4 or 5 of them are equity owners, that's a lot of people with a lot of skin in the game. Versus if you have a team of 20, 30, 40, 50 people, and you only have 2 or 3 equity ownership, the percentage of people who will care as much is going to be less because you're always going to care more when it's your own shop and everything like that. So I would say that's the first thing. The second thing is, as an investor, yes, you're not investing in the operator's business. You're investing in the entity that owns one piece of property. So as that investor, what you want your operator to do is make a business decision, what's in the best interest of that business LLC that you're particularly investing in. You don't want them to make a decision based on the best interest of the overall company because they might not be mutual. They might actually conflict with each other on a specific deal. So if you need to exit it, if you need to sell, not because it's a great time to sell, but you need to sell because you need your 30% of the profits to pay for the rest of the team, that isn't always in the best interest of the investor. So those are a couple of things that a big team might mean that I guess the overhead expenses are being subsidized by your investment. And that's not what you want That's not usually what you want as the investor in a specific deal.
I can agree.
So that was the question. I don't see the other question. I'm not really understanding. I guess you would ask an email. So we have 3 minutes left. I guess one thing, let's talk about recent events, right? And last week, I'm sure you heard, it was a pretty big alternative investment space, alternative investment niche that it's not looking great, right? Let's just put it that way. What would be your biggest takeaway from that asset class, about that situation, without mentioning any names, mentioning anything? And Joseph, if I'm putting you on the spot and you haven't heard about what's going on in the last week or two, just let me know and I'll chime in on my end.
Yeah. Can you help me with that? I was out in Miami all last week. What happened?
It's a derivative of the oil and gas space.
Oh, yeah.
Okay. All right.
Yeah, I actually don't know much about that.
Yeah, it's a recent one. Basically, it projected really high capital returns very early on, very aggressive tax benefits. And unfortunately, a lot of limited partners got involved in it, even though they don't have an oil and gas background, even though I feel like what happened was because so many of these deals in 2021, 2022 exited with these sky high IRRs, passive investors started overlooking the basics of due diligence and what is their actual expertise level. What are they good at analyzing? And I think because they skipped those steps, and there were a lot of capital raisers out there. And when I talked to a couple of people that ended up not investing, the biggest red flag they mentioned was they knew more about, let's put it oil and gas, let's say, it's not exactly oil and gas, than the capital raisers themselves. So another red flag is when you're talking to capital raisers, and obviously know the difference between a capital raiser and an operator. Even if you're talking to the operator, they should know certain things about their specific asset class. SIH Capital Group, we really specialize in affordable housing. If you ask me a question on affordable housing, I should really know the answer, and I should know it inside and out. So just be careful on those kind of deals. But Joseph, let's schedule a follow-up because I want to dive into some of these other red flags, and I feel like we cut multiple parts of this conversation short, and we're already at over an hour.
Yeah.
So can't thank you enough for actually being here. Last thing, why don't you just tell us where are people who listen to this webinar, where they can find talking to you? I know you're a relationships guy, so you're not, if my investors get on the phone with you, they're not going to be hearing about Break of Day Capital investments day one. It's about building long-term relationships. So where can our investors, get to know more about you, Joseph, and build that relationship with you?
Sure. It's very simple. I would love for you to contact me at joseph@breakofdaycapital.com. I want to have a personal conversation with you, not because I want to tell you about what we do at Break of Day Capital. That's only if you want to know. I'm an investor first and foremost, and I don't know what I don't know. And so it's really interesting. I love networking. You never know what you're going to learn from other people and just from sharing. And in fact, I just want to give a shout out to Preston. I just noticed that I actually just talked to him a couple of days ago when we had such a great conversation, just connecting about investing in passive investments and syndications. I just love that, that it's my passion and I can talk about it all day long. And if I can help you in any way, if you want me to look at your deal together and just have an opinion, not advice, but just have an opinion, I would love to do that for you.
Yeah, no, great point. And to your point, I've learned some stuff from my investors. I've learned from my investors as much as I try to educate other people. And I think that is 100% the truth. And I think me and you have a very similar philosophy on that. And I would definitely love to having you join again. If you guys are interested in these monthly webinars, we're probably going to have Joseph on sooner than later, probably, maybe sometime right after the summer. I don't know how your summer looks, but I'm going to have Joseph back on here again. And we're going to keep going into these red flags and what we see from an LP perspective. And if you're interested, please sign up for the monthly webinar. We put out one a month. We focus on quality, not quantity. So we really try to hone in on who exactly we bring on. So thank you guys for joining me. I apologize again that the video is off. And thank you so much, Joseph, for jumping on.
Thanks for having me, Dennis. This was fun. And hopefully the audience got some value out of it. And you guys have a wonderful weekend. This is what it's about, okay?
You got it. Take care, Joseph. Bye.
Take care.